There is a dangerous misconception spreading about the UAE's new electronic invoicing mandate. Many businesses assume it simply means exporting a PDF from their current accounting software and emailing it to a client. The reality is much stricter. The mandate is a complete restructuring of business IT. It requires adopting a highly structured, automated data framework that completely removes manual workflows from your billing cycle. Right now, this law specifically targets business-to-business and business-to-government transactions. If you operate exclusively in business-to-consumer retail, you are excluded from these requirements. For everyone else, there is a second major myth: the belief that you can outsource the legal liability for compliance and data accuracy to a third-party software provider. You cannot. The legal responsibility for correct tax coding remains entirely with your business. Preparing for this requires coordination across your IT and finance departments. If these teams work in isolation, the likely result is a misalignment between your accounting data and the mandatory reporting standards, causing the system to reject your invoices. The government is rolling this out in phases. Your specific deadlines are dictated entirely by your company's annual revenue. Phase 1 applies to large enterprises generating 50 million dirhams or more. These organizations must appoint an accredited service provider by July 31, 2026, and officially go live with the system by January 1, 2027. Phase 2 covers SMEs with revenue under 50 million dirhams, and Phase 3 applies to government entities. These groups must appoint their provider by March 31, 2027. Their go-live dates follow shortly after, in July and October of 2027. Missing these deadlines or feeding unformatted legacy data into the new framework on day 1 carries immediate operational consequences. Unvalidated invoices will fail to send, meaning your clients will not receive them. There is zero margin for error upon your go-live date. Businesses that wait until their deadline month to start testing their integration will face halted cash flow while they scramble to fix back-end data errors. To understand why manual data entry is obsolete under this mandate, we have to look at the underlying architecture driving it, the global PEPL framework, adapted here as the 5-corner model. Data flows from corner 1, your ERP, to corner 4, the buyer. Between them are corners 2 and 3, the accredited service providers acting as mandatory validation gateways. Simultaneously, data routes to corner 5, the Ministry of Finance platform for real-time tax validation. The entire process, from generation to validation, buyer delivery, and government reporting, happens in under 30 seconds. Because this hyper-fast middle zone removes human intervention entirely, absolute data accuracy at corner 1 is a non-negotiable prerequisite. If your initial input is flawed, the system rejects it instantly. Connecting your systems to this 5-corner model requires a readiness plan. Steps 1 and 2 separate B2B and B2G from B2C retail. Step 3, conduct a critical IT gap assessment, testing your software against the government's 50-plus mandatory checkpoints. Anticipate a week of IT effort for this assessment. Step 4, contract an approved ASP to serve as your network bridge. Finally, steps 5 and 6, run pilot tests and train teams, ensuring IT and finance align perfectly on tax code mapping. These 6 steps introduce upfront technical friction and costs. However, these steps are the absolute only proven mechanism to ensure a frictionless transition on your official go-live date. The most consequential external decision you will make in this process is evaluating and selecting the right ASP for your operational volume. Providers offer 2 models: fixed monthly subscriptions and variable per transaction fees. Per transaction is efficient for low volume, but scales poorly if volume spikes. You must also weigh integration. Deep API automation has high setup costs, whereas manual web portals are cheap but highly labor-intensive. When reviewing contracts, keep Ministerial Decision 64 in mind. It recommends ensuring your chosen ASP provides a baseline of 100 free electronic invoices per year within their terms. You have to strike the right balance. Over-investing in deep API integration wastes capital for SMEs. Conversely, relying on a cheap manual portal will paralyze the billing department of a high-volume enterprise. The trade-off of this mandate is clear. You are sacrificing initial capital and setup time to achieve automated compliance, fewer disputes, and faster collections. Your exact next steps depend entirely on your current operational reality. Let's map it out. If you are a large enterprise generating over 50 million dirhams, your deadline to appoint an ASP is July 2026. That timeline is much tighter than it appears. You must authorize your IT gap assessments today. Due to your volume, you have no choice but to pursue a full complex ERP integration, and those take months to build and test. If you are an SME under 50 million, you have until March 2027. Do not use this extra time to procrastinate. If your invoice volume is low, seriously investigate ASPs that offer manual portal uploads. It allows you to bypass heavy IT integration costs entirely while remaining compliant. But remember the core legal reality. Regardless of which ASP you hire or what size your business is, the liability for data privacy and tax accuracy stays strictly with you. Waiting for the final weeks guarantees failure. IT vendors and approved ASPs will face massive application bottlenecks as the deadlines approach. Take the first step now. Begin auditing your current tax codes and schedule an alignment meeting with your existing ERP vendor this week. Ultimately, a seamless transition depends on immediate collaboration between your IT and finance departments. A successful implementation is determined by how well these teams align their workflows before the mandatory go-live dates.